Here's a riddle. When are required minimum distributions not required? No, it's not a trick question, and we have just the person to solve this puzzle, Stephen Ashley. Stephen is a financial services professional with New York Life Insurance Company. So welcome to the show.
Thank you.
So RMDs are really just that, required minimum distributions. So how do you resolve this riddle I posed?
Well, first, you're right. RMDs are required minimum distributions, and that means that they offer for folks payouts that come from IRAs or retirement plans. And you have to take that when you become 70 and a half. Now, you put money in tax deferred, and it has to come out over time, over a period of time, as income, and that's taxed, unfortunately. Now, recently, though, we've had the Treasury has had new regulations, and those regulations provide another option.
Okay.
And that option helps to defer potential distributions down the line.
Okay. What's that called?
That is called a qualifying a longevity annuity contract.
Okay.
QLAC
for short, right?
Exactly, exactly. And it allows you to defer part of your distributions over time, and hopefully will reduce some of your taxes.
Okay, so you get them later rather than now.
Exactly.
But I've already set up an IRA. Am I too late to make this change?
No. Well, in fact, QLAC uses the money from your IRA or your qualified plan to set up the IRA. Now, there are some requirements, and they include the fact that you have to take that distribution before 85 at the latest, all right? And also, there's a payout. There are two payout options. One is a choice of life only, and the other is life with cash refund.
Okay, so what's the difference?
So the difference is, when we talk about life only, that says that the annuitants will receive income for as long as they're alive. But once they pass, then that income has to be turned into, or will go away, and if there's any principal left, that goes to the insurance company.
Okay, so nobody else gets it, just your life.
Just your life.
Okay.
Now, the other option, which is life with cash refund, again, the income goes to the annuitants while they're alive, and if they pass, that income, and there's principal still left, that will go to a named beneficiary. And so it doesn't go to the insurance company.
Well, that sounds like a good option.
You like that?
Is there a minimum amount you need in order to qualify for this QLAC?
Well, actually, the premium limit is $125,000. Now, it can't go any higher than that, but yours could go less than that, depending on your December 31st, 2016 balance.
Okay. So what is it if you have less than the required amount?
So as an example, if you had $500,000 or less than $500,000 at the end of December 31st, 2016, you would simply take that amount and multiply that by 25%, and that would be your amount.
Okay, so you've got an example for us too, right?
Yes, we do. So think about it. Think about it this way. So if you had, at the end of 2016, $300,000, and you took 25% from that, that would mean that your starting balance for your QLAC would be $75,000. But let's now look at the maximum. So if you had a balance of $800,000 and 25% was there, well, that comes to $200,000. Well, unfortunately, the maximum amount is $125,000, so you would start with $125,000.
All right. Well, I bet you're suggesting people talk to their retirement or financial specialist to make sure this is right for them, right?
Most indubitably.
All right. A QLAC, or a qualifying longevity annuity contract, could be the answer to your RMD riddle. But as Stephen said, you need to look at your entire retirement plan before saying this is the solution for you. If you need help, give Stephen a call. His number's next. My thanks to Stephen for spelling out this deferred income option.
Learn more by calling Stephen Ashley at the New York Life Insurance Company at 216-643-8313 or click to www.stephenoashley.com. Next,